Well, thank you all for joining. Good to see you all and great to have you here on this important product webinar that we're hosting. This is one of our quarterly webinars, and today's topic is financing 1 to 4 unit residential properties. My name is Craig Blodgett. I'm Senior Manager of Partnerships here at Loanspark. This is my contact info if you would like to reach me for any questions afterwards, or as I mentioned earlier, you can reach out to your dedicated account manager. Also on this call, I have my Director of Marketplace Lending, Thomas Black, who will be helping me dive a little bit deeper into our programs, how they benefit you as a partner or a prospective partner, and highlighting some of the recent deals that we funded in these types of product categories, as well as what it looks like to actually go through the motions of submitting the deal, and ultimately funding it with us through Loanspark. So, quick market update tip before we jump into the actual meat and potatoes of the presentation here is that nearly 1/3 of the largest 100 markets are now showing annual price declines, and inventory has been rising steadily over the past year, up 29% in June compared with the same month last year. And this is from an article posted by CNBC. Reason why this is insightful is because as markets start to soften, there become more opportunities for investors or other players to purchase properties, and they'll come to brokers, marketing professionals, people, anyone on this call really, to finance those types of properties. So we do expect the volume to experience an uptick, just because there are some factors here in certain markets that are either lowering prices and causing maybe opportunities to get a good deal, or likewise, just heating up markets that allow investors to really capitalize on investments they've already made and move into maybe their next project or portfolio acquisition. So before I pass it over to Thomas so he can kind of dive into what the programs offer specifically, let's define 1 to 4 unit investment properties at a high level. One thing to keep in mind here is that at Loanspark, we offer investment, commercial, and business lending programs. So we don't do anything that's owner-occupied residential, right? So whether it's a 1 to 4 unit purchase, whether it's 1 to 4 unit HELOC, ground-up project, if it's owner-occupied, it's not something that we can really help you with. But when it comes to investment properties, here are the properties at a high level that we can service. So single-family residences, right? This is going to be your 1 to 4 unit standalone property for residential use. Duplexes, same kind of thing, but typically there's going to be 2 entrances on the property, separated by a wall. Triplexes and quadplexes, same concept, just with more doors. And then condos and townhomes are going to be standalone owned, pieces of the property within a complex, right? So if you think about a large building where the borrower is able to actually purchase that specific unit of the building versus just leasing it, condos and townhomes are typically fall into that category. So that's kind of the 1 to 4 unit investment properties that we service on a high level. At this point, I'll pass it over to Thomas so we can explain more about the loan programs that we offer and the use cases.
Awesome. Thanks, Craig. So like Craig said, my name is Thomas Black. I'm the Director of Marketplace Lending here at Loanspark. And among other things, one of my chief roles within the company is to review your customers' requests and determine which of these programs that we're going to be discussing is going to be the best fit for their profile and their needs and everything like that. So at a high level, when it comes to 1 to 4 unit properties specifically, we have 4 programs that we would look to utilize depending on what your customer is looking for. So the first, which is probably the most common, is a DSCR loan. Second is a no DSCR loan, which we'll get into the details of each. The third would be a second mortgage, which I'm sure many of you are familiar with. And the fourth would be a bridge loan. Now, I'd like to specify in the context of today's presentation, a bridge loan is going to be a straight bridge, a short-term loan with no rehab funds, with no construction components of the deal. That's a program and programs that we'll be discussing in a future webinar. So one of the things that's important to understand when you have a customer coming to you looking for capital is what kind of information you need up front to size the deal. And so by explaining what we're looking for, I kind of give you an idea of the questions to ask your customers as well. So when it comes to sizing these deals and pricing them out, we're looking for really 5 key pieces of information. So the first is going to be where the property is located. So all things equal, deals in large metropolitan areas or non-rural areas are going to be easier to fund. Pricing is going to be a little bit better. Having said that, we can fund deals nationwide, even in rural areas, but understanding the address of the property, looking it up on Google, putting your eyes on the building, making sure it doesn't have fire damage, et cetera, is always going to be important. The second is going to be the debt service coverage ratio on the property in the event that the loan requires that. But just understanding if the property is generating income, and if it is, what the expenses are as well is going to be important to understand which program it's going to fit in. Then you've got, of course, your borrower profile. So what their credit score is and how much experience they have in the investment property realm is going to be important. I think someone who's a first-time home buyer who doesn't even own a primary residence, that's going to make their options more slim than somebody who, for example, owns 10 investment properties. So always important to understand your borrower. And finally, loan to value, as you can imagine, is always going to impact pricing. A lower leverage deal is lower risk to us, the lender, and therefore is going to be priced in a more advantageous way to your borrower. So we kind of covered this already, but again, as far as what you're looking to ask for from your borrower, where the property is located, how much money it's generating, and the expenses on the property, their credit score, of course, is going to be an estimate. We won't be doing any sort of hard pull in the deal screening phase. When the deal is going to move forward, we will. What their experience is, and then a couple more components that we didn't discuss on the last slide, which would be the occupancy status. So, for example, a 4-unit building that has all 4 units occupied is going to be a little bit easier to finance and have a little bit more competitive pricing than a 4-unit property that has 1 unit occupied, for example. And finally is the citizenship status of your borrower. So here at Loanspark, we have the ability to fund U.S. citizens, green card holders, foreign investors who live abroad, foreign investors who live stateside. We have a plethora of options, but understanding their status up front is going to help us quicker identify the best program that's going to be a fit for their needs. All right, so the first product I want to talk about today is a DSCR loan. So many of you probably know DSCR stands for debt service coverage ratio. So in layman's terms, this is a product that in the market is very common. And the reason it's so popular is it utilizes strictly the income of a property itself to qualify for the loan rather than the borrower's personal income or their business income or anything like that. So it allows us to just look at the property and say, is the rental income here sufficient to cover the expenses and the debt on the property? And if so, it's likely going to be eligible, barring other factors. So that's how you want to think about this product. Qualified based on the income of the property. And so let's talk a little bit about kind of what terms you would expect to see here. So most of the quotes you will see and terms you will see for a product like this are going to be a 30-year fixed rate loan. That's the most common. We do have the ability to go out to a 40-year fix, which, as you can imagine, is going to lower the monthly payment and the debt burden on the customer. So in the event that the debt service coverage ratio is a little bit tight, that may be something worthwhile pivoting to. Loan to value maximum here is going to be 80% for a purchase and around 75% on a refi. Highly qualified customers may be able to get 80% loan to value on a refinance, but if they're looking for cash out, you're generally going to see it topping out around 75. Rates here are starting nowadays in the low 6s, so 6 and an 8 to be specific, and origination fees as low as 1%. Now, I'd like to emphasize these kind of low watermarks of rates like this 6.125. These are going to come for highly qualified customers, so good FICO, and also not highest leverage deals. So for example, if somebody's looking to only put 20% down on the property, like we mentioned earlier, less money down is higher risk to the lender and it's going to come with a little bit higher of a price tag. And so when you're discussing these products with your customers and trying to understand what they're looking for, understanding their needs and their tolerances is really important. Are you more concerned about minimizing your money down? Or are you more concerned about getting the best rate? Of course, there's give and take in all of these things. Finally, these loans will always come with some form of a prepayment penalty. The standard is going to be a 5-year prepayment penalty, but it can be bought down as low as 1 year. Sometimes it'll be through origination fees. Sometimes it'll be through an add-on to the rate, but you have the ability to buy the prepayment penalty down. There are some states, Pennsylvania, for example, where prepayment penalties are not allowed at deals of a certain size. And so there will be those exceptions to this prepayment rule, but generally speaking, you can expect a 5-year prepay with as little as a 1 year as an option on a buy down. So here's an example of a deal we recently funded. It was probably 2 or so months ago in Canton, Ohio. Fairly straightforward deal. Customers looking to purchase a single family residence as a rental property. They're looking for 75 loan to value, which was a loan amount of $560,000. If memory serves, their FICO was somewhere in the low to mid 700s, which resulted in a rate of 7.25. So again, a little bit higher than that low water mark of 6 1/8 because their FICO was good, but not as high as it goes, and the loan to value is a little bit higher. So coming in at 75 LTV, you're getting the 7.25 rate, which is still highly competitive. And the deal closed in, I believe, 25 days is where we funded. So fairly quick. It's possible to do it quicker, certainly. You're generally looking at 7 to 10 days on appraisal turn time, and then another 2 weeks of underwriting. But this is kind of a fairly common example of the type of DSCR loan that we see and fund frequently. All right, so the next product we want to discuss here is the no DSCR loan. It's kind of a logical next topic following the DSCR loan, and it is exactly what it sounds like. It's a product that we are not concerned about running a debt service test on the property. So as you can imagine, a common use case for this product is going to be when the rental income is insufficient to cover the debt. So perhaps your borrower is buying a property that they see as a long-term investment, and maybe today the rental income is a little bit too low to service the new loan payment in today's rate environment, but they want to buy the property anyway. This is the product that's going to be a great fit for them. We're not going to be looking at the rental income whatsoever. And so, as you can imagine, this product there are less options in the market for a product like this. Most lenders, including us, are going to be looking at the debt service coverage ratio. But in the event we decide to use a product like this, the terms are going to be fairly straightforward, as you see on your screen here. So all of these are going to be a 30-year fixed rate loan. You will have the ability to select an interest-only option for this product if your borrower chooses. Maybe they can go up to 10 years only payments, which will allow them to lower their monthly debt burden a little bit. Loan to value here is going to be a little bit lower than the debt service coverage product, so up to 75% on a purchase or a refi. The borrower is going to qualify for that 75% if they have more experience and better credit score. So someone who's only got one investment property may not quite qualify for that max leverage. Rates here are going to be starting somewhere around the low 8s. Again, experience and credit and loan to value dependent, and the origination fees, same as before, are going to be starting around 1%, depending on deal size and the borrower's profile. And finally, everything I said about prepayment penalty on the last slide can be iterated here as well. So standard's going to be a 5-year. It can be bought down to as little as 1 year, and in some states the deal will be exempt from a prepayment penalty altogether. So this is an example of a deal that we funded recently in Charlotte that kind of mirrors the scenario I was talking about before. So this is somebody, a young professional investor, looking to buy, I think it was his 3rd property. So really looking to start building up a good portfolio. Identified a property in an area of Charlotte he believed was growing quickly, and the property, in his opinion, had great potential for future appreciation. But the rental income really just wasn't enough to support the $750,000 loan and the debt payments associated with it. And so rather than try to acquire this property with cash, which is obviously quite difficult, and raise the rents or put additional money down to keep the debt payments low, he just elected to pay a little bit higher of a rate in order to access a no DSCR program. So in this case, we're able to give him a 70 loan to value and a resulting loan amount of $750,000. His rate came in at 8.25%, and he's closing this deal in under 3 weeks. So this is a perfect example of the type of borrower that this program is a great fit for. So the next product here is going to be a second mortgage DSCR loan. So for those of you who are not familiar, a second mortgage is in essence where the lender is sitting in is a second position lien holder on the property. So if tomorrow I decide to go out and buy an investment property and hold it for a year and then decide I want to access more cash out from the property, but I don't want to touch my first mortgage, maybe the rate's really good, maybe I don't want to go through the headache of all the additional fees, whatever reason, I may elect to take out a second mortgage on the property to access cash out or equity that I've built up in the property in the form of cash out. That's what this product's great for. So most common example you'll see here is someone who bought their investment property when rates were very low. So as you can imagine, if you have a mortgage that's at your 40% equity in your property and your rate's 3% and you want to access some of that property equity, it doesn't really make sense to touch that first mortgage sitting at 3% when the rate environment is just higher nowadays than it was in 2020, 21, 22, right? And so that's what this product's a great fit for. So terms here are going to be, once again, 30-year fixed. I mean, this is the most common term length we offer. Combined loan to value is going to be up to 75%. And what combined means is you're essentially taking the loan value of the first mortgage, the loan value of the second mortgage, and dividing by the appraised value of the property. So basically, we're just making sure that the borrower has at least 25% equity on the project. And I do see a question, Robert. No, this is not a HELOC on the property. This is a true second mortgage. It functions a little bit differently. So we'll have a fixed payment over that 30-year term, have the prepayment and everything like that. So because it's not a HELOC and because it's not a first mortgage and because the lender, in this case, is sitting in a second position, they're naturally at more risk in this case, right? Because they're waiting on the first mortgage. In the event that the borrower defaults on the property, the first lender is recouping their money first. And so the second mortgage holder is naturally charging a higher rate for this additional risk that they're taking on, which is why compared to a low sixes rate on the DSCR loan, the second mortgage DSCR rate is going to start somewhere around the mid nines. And correspondingly, the origination fee is going to be a little bit higher as well, starting somewhere around 1.5. And this number may be a little bit lower depending on the deal. It may be a little bit lower for $1 million deal, maybe a little bit higher for a $250,000 deal. It just kind of depends on the borrower profile and deal size. Now, there is not a no DSCR option for second mortgages. So in order to qualify for this program, the debt service coverage ratio on the property must be in excess of 1.0. And to clarify, this debt service ratio is run based on our new payment on the second mortgage, as well as the payment of the first mortgage. So they're looking at all of the debt on the property and making sure that the rental income there is going to cover both of those mortgages in order to qualify. Same thing here about the prepayment penalty. I'm sure you're sensing a theme at this point. Standard prepay is going to be a 5-year. It can be bought down to a 1-year. Some states are going to be exempt. And one more thing to point out here, because this product has limited availability, we will not be able to finance any rural properties for this program. So think, roughly speaking, towns of 25,000 population and above, or located within 30 miles of a major metropolitan area, 100,000 population and above, roughly speaking. The USDA, if you go to the USDA website, they also have a great tool where you can punch in an address and it will tell you if the property is located in a rural area or not. So if you're unsure, you're on the fence, there's great resources out there to tell you. So another quick example of a deal here, I think this was, memory serves, the exact situation I mentioned before, where someone had bought this property about 3 years ago, had a rate probably under 4%, and needed to access some additional equity in that property without touching their first mortgage. Makes sense why they wouldn't want to do that. Their payment would go up drastically if they did. So they come in looking for a cash out refi in the form of a second, looking for $350,000. They remained below that 75% combined loan to value threshold, landing right at 73, and their rate was 10.375. The reason the rate was not near the low water mark of what we presented on the last slide is because their credit score was a little less than desirable, which limited their options. I believe it was high 600s. So still doable, just not going to get you the best rate. All right, so the final product here is going to be a straight bridge loan. So like I mentioned before, we're not talking about a fix and flip loan. This is a product that's not going to have rehab funds associated with it. That's something we will discuss in a future webinar. This is going to just be a loan that is interest-only payments with term lengths ranging from 6 to 24 months. I would say 12 is the most common that we see. So the most common use case here for this product is going to be someone buying a property at a value they deem very competitive. Essentially, they're getting a steal. Perhaps they've negotiated a very good value from someone they know personally. Perhaps they sourced the property off market, and they've decided, you know what, I'm buying this property well below what I think someone would pay for it. And rather than do the rehab myself or rent the property out myself, I'm just going to get myself a 12-month term and try to sell this thing and make my profit and move on. This is something we see very often. Auction's a common example too. Someone buying a property at auction that they think, you know what, rather than go through the headache of renting this out or rehabbing it, I'm just going to sell it and make my profit inside of 12 months. That's what this product is great for. And so again, you can go out to 24 months, maybe even 36 months in some cases, although, you know, it's not as common that the individual or the borrower's use case is going to require that much time, but it is this possibility. Loan to value here is going to max out at 75%. I would say most of what we see is around 70%, especially to access the most competitive rates. So again, because it's a bridge and all things equal, bridge loans across all asset classes tend to be more expensive. You're going to see rates starting somewhere around the low 9s here. Now, it's possible to get in the high 8s if your borrower is willing to put 35 to 40% down. But again, most borrowers are looking to put 20 to 25, maybe 30% down. So that's kind of where you're going to see those rates starting at. Again, origination fees a little bit higher, as low as 1.5%. And with these loans, the prepayment penalty is a little bit different. So some of them will have no prepayment penalty altogether, and some will have a prepayment penalty in the form of what we call minimum interest. So it may say minimum interest of 6 months. And what that means is if the borrower pays the loan off after month 4, they're going to owe an additional 2 months of interest to bring those total interest payments up to 6 months. But if they pay off in the 7th month, there will be no penalty associated with the loan. And so again, I mean, this prepayment penalty component is the most compelling reason, if you're looking to sell the property quickly, to use a loan like this rather than a DSCR loan. Because, you know, unless you buy the prepayment penalty down on a longer term product, if you decide to refinance or sell the property in the 1st or 2nd year, you know, again, if you haven't bought the penalty down, you may be paying 3, 4, 5% as a penalty for selling the property early. And so rather than deal with that and rather than buy that penalty down, you're better off just tapping into a bridge loan. And again, one more huge advantage of this is interest only payments. So you're just going to be paying interest only. You're going to have a balloon at the end, but if you're selling your property and you're selling it for more than you paid, a balloon at the end is not really of much concern to you. So quick example here, we had a borrower, again, looking to do exactly what I just mentioned, bought the property at what he believed was a very competitive price in a really nice area of Phoenix. And he was paying, you know, a little over $1 million for the property and was willing to bring 35% down because he felt like he could sell the property inside of 12 months. So we gave him a 12-month term, interest only payments at 9.875%. His rate was, I would say, fairly competitive due to the fact that he put a little bit more money down. Loan amount was $805,000, and we were able to close this deal in 15 days. So great win for him, and I believe he already has a buyer lined up for this property, which kind of justified his decision to use a bridge loan for this example. All right, so now I want to go over a couple tools that we've recently rolled out for referral partners and brokers they're very beneficial when it comes to helping you screen your deals. So the first is going to be a debt service coverage ratio calculator, which we'll walk through an example in a sec, but it's essentially going to show you and give you a template for how to determine if your borrower's property is able to make their debt payments or not based on the rental income. It's a really useful tool because it allows you to show up to us with a deal that you've kind of already screened yourself. And these are the tools we use internally to screen your deals as well. The second's a closing cost calculator. So probably one of the most common questions that the brokers on this call and really us internally get as well is, what are the closing costs in this deal? What fees am I paying? Borrowers want to know upfront all of the costs that are going into the loan, and they have every right to know that. And so we've built a calculator that's going to allow you, with very low margin of error, to estimate what their closing costs are going to be. And this is also something really useful to use up front, because, for example, if you have, let's make a number up. Let's say it's $1 million single family home and your borrower tells you they only have $200,000 to put down. Well, you may run that example through the closing cost calculator and realize they need, I don't know, $60,000 to $65,000 as closing costs. So if they only have $200,000, you know right away they're going to need to either find capital from another place, or the program may not be the best fit for them. And so having an idea of how much liquidity your borrower is going to need to have to ultimately close this deal is really important to know up front, so that we are all spending our time on a fruitful cause. So Craig, if you want to go ahead and pull up the DSCR calculator first, we'll do a quick example. So this is a tool we use for 1 to 4 and commercial properties, but because we're talking about 1 to 4 properties on this call today, we'll go ahead and start by selecting SFR 1 to 4. So for the sake of this example, we'll use nice clean numbers. So like I just said, we'll do $1 million property value. And we will say that the property, so first I'm going to give an example of a property that doesn't cash flow. So let's say the monthly rental income is $4,000, Craig. And we'll say, you can go ahead and punch in 70% on loan to value, which will auto-populate the loan amount. And then you can go ahead and punch in a 30-year loan term, since that's the most common term that we see here. And we'll do an interest rate of 7%, just for nice round numbers. So once you punch in all this information, as Craig just did, you've got the loan information. The last thing to punch in is going to be the expenses on the property. So we have a property expense section down here. Now, before Craig punches these numbers in, I kind of want you guys to know, finding property taxes, especially in the 1 to 4 space, is actually very easy. Most of the time, that information will exist on Zillow. And so you can see whether it's a refinance or a purchase, you can go down into the details section of a Zillow listing, or just, it doesn't even have to be a listing for a property being sold. You can just scroll down into the historical details in Zillow and see what the current property owners paid the last year in taxes. And so always good to kind of check on that and make sure the numbers are making sense, because you want to spend your time on a deal you can actually get paid on, right? So on taxes, Craig, let's say $150 a month. I know for those who live in the Northeast, that seems like a low number, but I'm here in South Carolina. That number makes a little more sense. So, and then we'll go $150 a month on insurance as well. And you can do $50 a month on HOA. And then just scrape out the maintenance. All right, so we got all our expenses, we got our rental income, and we got what kind of loan we're looking for. Now you're going to scroll up to the top of the page on the right and click calculate DSCR. Okay, so now we know the DSCR on this property is 0.8. So once you have an idea of what this ratio is, you have a few different options. Really 2 main options. We talked about the no DSCR product, which is not going to check this. There's not going to be a test that it has to pass for the debt service coverage ratio. So you have the ability to put it in a program like that. Of course, with the caveat that that program has a little bit higher of a rate. The second thing you can do, you know from this ratio that the debt payments on this property are too high to cover this $4,000 a month rental income. So one of the ways to fix this ratio is to lower the debt payments, and the best way to do that is to lower the loan amount. So if we want to hit a ratio of 1.0 and you want to find out what that loan amount is, what you do is you scroll to the bottom of the page and you punch in your target DSCR. So in this case, we're going to say 1.0. Then you go back up to the top and you click calculate max loan amount. So now the tool's letting you know, look, you asked for $700,000 and those debt payments are a little bit too high. But if your loan amount was $548,622.62, you would be right at a 1.0. So just to confirm that, Cray, you can copy and paste that into the loan amount and then calculate the DSCR, and you'll see it comes out to a 1.0. So very useful tool here. So, if you're having as a broker, if you're having this conversation with your borrower before you've spoken to someone on our team, by doing this, you're very well armed with information, because now you can present a couple options. Would you like to use a no DSCR loan, which we can do up to $2 million on 1 to 4 unit residential properties? Would you like to go that route, which is going to cost a little bit more, but it's going to require you to put less money down? Or do you have a little bit more money? Yeah, exactly. More down payment money required. Bring more money down. You'll get a much better rate, but your loan amount's going to be a little bit lower. And that's really a great conversation to have up front to find out where your borrower's head's at and what their sensitivities are. So that's this tool in a nutshell. If you guys ever have questions on how to use it, you can reach out to Cray and he can help you with it. We both use this tool all the time, but it's a very, very useful tool for what we do on a daily basis, and great for sizing up your deals. So great. Next, let's take a look at this closing cost calculator, and we'll give them a quick example on what this would look like. And I'll try to use the same example from memory here, with the same numbers and everything, so it makes sense. So again, we use this for commercial and 1 to 4 properties, but since we're doing 1 to 4 here, we'll go ahead and select 1 to 4. And so you selected purchase, I think under loan type, right? Select 1 to 4 unit property, residential DSCR. So let's do $1 million property value on the left-hand side. And we'll say our down payment is $300,000. Do 70 loan to value here. And we'll say the property is located in Texas, where Cray lives. So then we'll punch in 7% on the interest rate. The amortization type is, like I said, almost always going to be fully amortized unless your borrower selects an interest-only option, which will help them in some cases qualify for a little bit more money. But generally speaking, you're going to see that 30-year fully amortizing. So we'll do 30-year on the loan term. We'll just say, let's go August 15th on the closing date. It's about 3 weeks. It's pretty common for how quick these tend to close. That's fine. Yeah, whatever. It's fine. We'll do 1.5. Let's do 2% on the origination fee, because if you're a broker and you're bringing us a deal, of course you want to make your money too. Discount points refers to a rate buy down. So in some cases, your borrower may be looking to buy down the rate. Perhaps they just want a lower rate and lower payments. Perhaps they actually need to do that to make it qualify for a debt service, but we'll leave that blank for this example here. And finally, we'll use the same numbers from our last example. So we'll do $1,800 annual property taxes and $1,800 annual insurance. All right, so now Cray is going to scroll up and click the calculate button. And so this is going to give you a fairly comprehensive breakdown of how much money your borrower's going to need to bring to the closing table. So of course, it's going to give you all the details we put into the beginning. It's going to tell you their monthly obligations, so their P&I, their taxes, and their insurance. And then down below is where we're going to see all the fees broken out. So of course, you've got the origination fee. The little edit button to the right of where it says 14,000 is where you can modify that if you need in real time. So you don't have to start the example over. You can just change the number there. Of course, we had no discount points on this deal. And then, of course, as many of you know, most of these deals are going to have processing fees, underwriting fees, attorney fees, and all the third-party fees below. And so you will see the lender fees along with the origination fees, and then the third-party fees will be broken out separately. So again, I'd like to clarify this is always an estimate, but we've tested this fairly thoroughly, and it has a low margin for error. It's typically pretty accurate. So this is where if your customer's asking you, what's the attorney fee? What's the settlement fee? What's the title insurance fee? This is a tool that can give you a pretty good estimate on all these things. So now if Cray scrolls all the way to the bottom, everything should be totaled up. And so like I mentioned earlier, if your customer's telling you, I only have $300,000, that's the most I'm completely tapped out past that. I don't have $301,000. And you run this calculator and you see that they need an extra 29. Now there's a conversation that needs to be had. Maybe you pivot to a different product that allows them to bring less money down, or whatever the case may be. But always good to know. That's one of the most important things for a borrower. Borrowers always want to know rate and loan amount and everything like that, but they also need to know what they got to write a check for at the end of the day. That's a very important piece of information. And this tool is going to help you determine what that number is. All right. So like I said, these are free tools. We'd love everybody to be using these tools, all the brokers and referral partners on this call. So if you would like access to them, just send an email to support@loanspark.com with calculator or Loanspark calculator in the subject line, or you can just Google Loanspark calculator and you will find access to both of these free tools. All right, so now let's talk a little bit about what documents we're going to be looking for from your borrower once they've decided to move forward with a Loanspark loan. So we're always going to pull their credit report. As we mentioned, that's a fundamental piece of pricing and screening these deals. Most of the time, we're going to require an appraisal as well. I'll just tell you, we're always going to require an appraisal on permanent loans or long-term loans. There will be some cases where a bridge loan may require what's called a desktop appraisal. So essentially, we will internally evaluate the property based on resources we have at our disposal rather than sending an appraiser to go out and value the property. But I would say that's fairly uncommon. We're going to need their entity documentation, so their articles of organization for LLC and their operating agreement, etc. We're going to need all of their insurance documentation, proof of insurance on the property, and of course, understanding what that monthly burden is for the insurance, because that factors in the debt service underwriting. In the case of refinances, we'll always be looking to get the leases on the property. Now, when a property is being purchased and it's vacant, there are no tenants, that's going to be okay. We're going to defer to the appraisal to tell us what they think this property could rent for. And so in that instance, leases aren't going to be required. But in most cases for a refinance, we're going to need to see the leases because vacancy becomes much more of a limiting factor on those types of loans. And finally, if it's a refinance, of course, unless it's a cash out refinance where they have zero debt, if it's a rate term refinance or they have debt on the property, we're going to need to see a payoff letter from that current lender to verify that the number they're telling us for their current debt is in fact correct. So now I want to talk a little bit about some of the unique offerings of this 1-to-4 program. And for those of you who were on this webinar last year, we really didn't cover a lot of this, but because we found that this especially the DSCR product is so widely available in the market, we really wanted to give you information about what kind of sets our programs apart, because the DSCR program at the end of the day is fairly cookie cutter. And like I said, a lot of people offer it and it's fairly straightforward to qualify for, but there are a lot of components and characteristics of deals that would quickly make it ineligible. And many of these characteristics are things that we here at Loanspark can actually work past and find a way to get the deal done. So I'm going to rattle some of those off real quick. So like I mentioned on the last slide, vacant properties for a purchase is okay. Rural properties is okay as well. So if you have a property that's in a town with a very small, perhaps 5,000 people, or it's in the desert in Texas, that's okay. I'd say the one caveat to that being okay is just making sure that there's sales comps for that property. So making sure that when the appraiser goes out and the appraiser looks up what the property's worth based on how much similar properties have sold for historically, you just want to make sure that the value's there before you have your customer spend the $700, $800 on the appraisal. Short-term rentals are also okay. I mean, with the growth of VRBO and Airbnb, this is a very common question we get. Can I get financing on a property that's used as an Airbnb? And for our programs, the answer is absolutely. Again, the no DSCR product is something we covered at length, but this is highly advantageous to be able to do loans up to $2 million without checking the lease income on the property. That's something that's not terribly common in the market and something that can really be used to the advantage of your borrowers and ultimately you, the brokers, as well. We also have, some of the programs will have an acreage limit, but we can do properties that are in excess of 10 acres. In a lot of cases, the appraiser will be instructed to only value 10 acres of the property, not the entire property, but this 10-acre number is still fairly large. A lot of lenders will require the property to be perhaps less than 3 acres. And so, especially when you're talking about rural properties in areas where homes are being sold with large parcels of land attached, this is going to be a huge advantage. For deals where the leverage is under 50%, so whether your borrower is looking to get cash out or buy a property and put 50% down, we actually don't have any FICO minimum, which, as you can imagine, is very advantageous. Borrowers have, for all sorts of reasons, lower FICO sometimes because of mistakes they made in the past or because of bad business dealings or whatever, and we don't believe they should be prohibited from buying properties or accessing cash out. And so that is why we have this program available to them. So in a bridge context and a 30-year fixed on context, if the leverage is under 50%, they'll be able to secure property with no FICO score or no FICO minimum. I would say the caveat there would be, we're always going to look at the credit report and make sure that they don't have excessive mortgage rates. Would be okay, but if they're not current on any of their mortgages, that would be something that would need to be resolved prior to closing. But this program has a lot of flexibility. Another advantage is that we can use the owner with the highest FICO as a guarantor. So if you have two 50-50 owners and you want to leave the individual with the lower credit score off of the property, we have a program that allows for us to do that, which is hugely advantageous. As you can imagine, also affects the pricing in a strong way, because even if the lower FICO owner still qualified based on their credit score, it might impact the pricing in a negative way. And so it's better to leave them off. We also have programs that allow for no seasoning on entity owner changes, meaning perhaps your borrower wants to add a guarantor with much better credit score a day before they bring us the loan. There's a program that will allow for that, while most lenders will restrict on that. It will require 6 or 12 months of title seizing. So in essence, they will say the ownership structure of this property has to be set in stone for 6 to 12 months before we finance this loan. So hugely advantageous here. Another one of the most highly requested programs we offer is the foreign national and foreign investor program. So like I mentioned before, U.S. citizens are fine, green card holders are fine. Foreign nationals who live in the States, perhaps on a work visa or a travel visa, we can finance their properties. Foreign investors who live abroad and want to buy an investment property in the U.S. are acceptable. And foreign investors who still have citizenship abroad and no U.S. citizenship but live in the States are also able to buy properties for these programs, and some more examples in between. And so leverages and loan to values will vary for these types of borrowers depending on kind of the specifics of where they live, what documentation they have, et cetera, et cetera. But definitely a program we'd love to see borrowers placed into, because again, a lot of these borrowers don't have a lot of options when it comes to securing investment properties in the States. Another program we offer is first-time home buyers. So in the 1 to 4 space, first-time home buyers are meaning someone who doesn't even own their primary residence is fairly widely restricted. I think there's a common belief in the industry that if someone is buying an investment property and they don't own their home, it's more likely that they move into that home. And so a lot of lenders will restrict these first-time home buyers from their DSCR programs. We don't have that rule here. So your borrower does not, they can rent their primary residence, they can never have owned a home or an investment property, and we can still finance a purchase for them. There will be some LTV restrictions that will, in most cases, not qualify for max LTV, but could secure the property nonetheless. We will also allow for gift funds as down payments, reserves, closing costs. So hugely advantageous here. Someone who is, perhaps they came to you and they thought their 20% down was enough, but the debt service coverage ratio wasn't there and the closing costs were more than they expected. And so their parents were willing to gift them some money. Well, again, a lot of lenders are going to restrict on those gift funds. They're going to do what's called sourcing and seasoning. So they're going to see where the money come from and how long has it been in the account. And that will impact the availability of loan options to the borrower in that example. But again, we don't do that. We allow for those gift funds. We also allow for seller seconds. So for those who aren't familiar, a seller's second is essentially a second mortgage, like we discussed earlier, but it's held by the seller. So this is actually very common. Individuals will look to sell their properties, but they will be willing to lend money to the person buying their property at first. So, maybe they're keen on that additional cash flow, keen on that additional interest. And when it comes to these purchases, we allow for those seller seconds to be in place with up to 90% combined loan to value. So if you have a borrower that only has 12%, 15% to put down, and we issue a quote for 70% loan to value, if they can convince that seller to give them a second mortgage, they'll still be able to get into this property. We also allow for portfolio deals or blankets. So this means a loan with multiple properties as collateral. So perhaps someone's identified 4 single family homes at addresses next to one another. And rather than do 4 individual loans, they want to do it all in one loan and all have one lump sum monthly payment. We have that program as well. We also allow interest reserve on bridge loans, which means that built into the loan can be some additional money that will cover the borrower's 6, 9, 12 months worth of payments. So that is an option in some cases. Very advantageous should the property not be cash flowing in a way that allows them to make those payments. Like I mentioned before, we don't source or season on the cash to close or the reserves. So if they want to borrow money or get gift funds or borrow from a friend or whatever, we're not digging too deep into that. That's a great option for them. And finally, we allow for properties that have been recently listed on the market. So another thing lenders commonly restrict on is they say, look, if you've listed this property for sale on Zillow, it needs to be taken down for at least 90 days before you qualify for our loan program. While we do have programs where that is the case, we also have programs where that is not the case. And we can ignore the fact that that property was listed as long as it is delisted prior to closing. So last slide here is going to be what we'd call relevant factors. I would consider this components of a deal that affect the borrower's eligibility, or more like nice to know. They're not immediate disqualifiers, but information that we'd like to know up front so that we can pivot the deal to a different program or ask for additional documentation. This is just things that might affect the terms of the deal. And again, better to know up front, not the type of stuff you want to find out on the back end. So deferred maintenance is a very common one. If your borrower has a property that's perhaps it was damaged in a fire, perhaps they bought a dilapidated property, the properties with deferred maintenance are going to not be eligible for permanent financing. We need to know this up front so we can position it in a bridge loan. Any recent ownership changes is important as well. Any modification to the entity, like I said, we're fine with that, but certain programs disqualify it. Same thing with properties recently listed for sale. We're fine with it, but there's programs that are going to disqualify it. Another big one is when the property was purchased. So if someone's looking to do a cash out refinance, there's typically a seasoning period required to access equity in the property. And so it can be 2 months, it can be 9 months. There's no restrictions per se. We can still finance the deal either way, but there are programs that will become ineligible if a certain amount of time is not seasoned or has passed. There's not a certain amount of seasoning. Also good to know if they want to sell or second, because again, we have a program that allows for that 90% combined loan to value, but not all programs are going to allow for that. Always good to know about their negative credit history. It's one thing to know the number. It's another thing to know why that number is that number. So if somebody has 3 missed mortgage payments and they still owe the bank that they bought their investment property through a bunch of money, they're going to have to get current on that loan before we close the deal. Also, always good to know if their down payment, closing costs, or reserves are coming from gifted funds, because again, we have to put that in the right program that allows for it. Very important to know if they have recent foreclosures or bankruptcies. There is a program that allows for 1-day seasoning there, but it's going to be lower leverage. We need to know that up front. Again, size of the property and the acreage, that's something we can find out on our own, of course, but always good for you to catch that as well. Because in the case of an 11-acre property, if you're only appraising the property at 10 acres, it's not going to affect the value that much. But if you bring us a 30-acre property and we're saying, hey, we're only going to look at the value of the house plus the 10 acres, that's going to significantly impact the value that the appraiser ultimately comes up with. And finally, the borrower's experience. So always important to know, not just are they a first-time investor, but they actually own their primary residence. All right, so that's my piece of the show. I'm going to pass it back to Craig, and he'll tell you a little bit more about how to work with us, whether you're referring deals or brokering them. So thank you for your attention.
Awesome. Thank you, Thomas, for those insights. I do see a few questions in the chat, so don't worry. We'll circle back to those at the Q&A session at the end. Before we get to the Q&A, I just want to cover a couple of topics about how to work with Loanspark. I know we have plenty of current partners on the call, as well as some prospective partners, so I think this is a good thing to highlight. So there are a couple of different ways you can work with Loanspark when it comes to submitting leads. We have two buckets, referrals and broker deals. So each of these are available to you on a deal-by-deal basis. By partnering with Loanspark, you can pick and choose which option works best for you on each lead you submit, and you simply select each, the submission type on the actual lead form that you'll use to submit the lead. So at the bottom right of the lead form, it'll ask you whether you want to refer this deal or whether you want to broker it. The differences between the two are really on the process and your role that you'll play as the submitting agent, as well as your compensation on the deal upon funding. So first off, referral. This is essentially a handoff to Loanspark, right? It allows you to fill out the one-pager lead submission form, and it goes to our team. We'll focus on the document collection. We'll focus on reaching out to the customer from a 617 phone number, and we'll end up processing and closing the deal for you while you focus on your bread and butter, right? So this allows you the best use case for it is typically someone who either doesn't feel comfortable moving that type of deal forward. For example, if you have a specific niche in commercial real estate, or maybe you specialize in this type of mortgage space. If that's kind of your bread and butter and you want to stick to that, but also have a way to service your new and existing clients, referral may be a great option for you in that case. You'll make 20% of the gross margin meaning whatever we bring in as a company on the deal. So whether it's $1,000 to Loanspark in origination, origination revenue, or it's $100,000, 20% of that is sent to you as a referring agent. And then, of course, we work with the applicant directly. So we will actually, upon intake of the form, reach out directly to your client from a 617 phone number. Our entire team will reach out from a 617 phone number. We'll let the client know, hey, we received this lead from so-and-so, wanted to talk to you about this, and we'll outline the next steps, right? We'll explain to them their options, documentation requirements, and the offers once we receive them, as well as walking them through the closing process. So we do everything for you. If you would like to broker a deal with us, you'll have more control over the deal process, and in most cases, make more revenue because you'll be, in charge of collecting the documentation and moving the deal forward. So in the broker case, and again, you can just select that on the lead submission form. We would act as a direct lender. You'll be in charge of collecting the documents with our support. So we will provide documentation checklists to you upon receiving the lead form. You'll still have hands-on support from our account management team on that file, but it will be your responsibility to move the deal forward. With this specifically to 1 to 4 unit investment properties, there's a variable upsell structure, meaning that you can typically charge up to 5 points as a broker, in addition to our lender fees and other closing costs. And as I mentioned, we work with you directly. So if you're set up as a current partner, this is great to know so that you can decide which works best for you when you have a scenario to submit. If you're not set up as a current funding referral partner with Loanspark, definitely reach out to Sasha or go on to our website so that we can get you set up as soon as possible.